Hey everybody, welcome to your weekend review for the week of Monday, January 30th, 2023. And oh, what a week it was. On Monday, MBS were down 28 basis points early. Equity futures fell on Monday along with stocks in Europe as a note of caution crept in to start the week. It's going to be punctuated by the Federal Reserve meeting. Federal Reserve officials are expected to raise rates by a quarter percentage point on Wednesday, dialing back the size of the increases for a second straight meeting after recent data suggests the central bank's aggressive campaign to slow inflation is working. Signs of earnings pressure, however, are raising concerns about the health of the economy and the outlook for equities, though that is not a big concern of the Fed for the most part. Right now, it's a tug of war going on between the markets and the Fed. The market's firmly priced in peak Fed rates of about 4.75 and rate cuts starting in November, while the Fed is fighting to convince markets that rates will actually go higher and hold there longer. The Fed has to be concerned that if market starts to rally, it'll bring more price inflation pressure because of increased economic activity. The Atlanta Fed's GDP Now estimate for Q1 is a mere 0.7. This was like 2.5 fairly recently. Note that GDP Now estimate is significantly higher than the first estimate of Q4 GDP, about 60 basis points too high. We also get jobs on Wednesday and Friday, and the market is looking for about 175,000 job creations. So the day went on, it kind of bounced around. We ended up being down 12 basis points on the day at 101.38, which is putting us right underneath that red line, which is the Fibonacci retracement level. Sorry about that, I got a call. And very narrow range where the 25 and 50-day moving averages are converging in on each other right around 101. We also got some news. Basically, economists Jeffrey Lacker and Charles Poser penned an op-ed for the Wall Street Journal about Fed policy and inflation. They discussed the use of rules like the Taylor rule, which calculates a Fed funds target rate. Based on the inflation numbers saw in December, these rules would suggest that the Fed funds rate should be about 8% right now. So take that for what it's worth. While we only have 2 trading days left in January, unless agency mortgage bonds suffer quite the shellacking over the next 48 hours, we should see a record positive excess return for US MBS. That's easy to say. US MBS index for the month currently stands at 1.2%, which is far above the 0.01 return seen for this month on average this millennium, and is the 0.56 record seen in 2009. So this is basically further evidence that once the market feels like the Fed has done its course, there is room for improvement in bonds. We also got a post from our sponsor at WellThatMakesSense.com, which is a passage from Jocko Willink. Discipline can seem like it's your worst enemy, but in reality, it's your best friend. It will take care of you like nothing else. The most important discipline will put you on the path to freedom. So definitely check out these spots at our sponsor at WellThatMakesSense.com. And on Tuesday, the UMBS were up 9 basis points. By the time the West Coast got up and got moving around, that was down about a quarter from the high of the day, which was real early. The employee cost index is an economic report that was never really on the radar as a top-tier market mover in the past, but ever since Fed Chair Powell started calling this report as a source of guidance for potential wage pressures, we've seen much bigger reactions. So the ECI came in at 1.0 versus a 1.1 forecast. It was 1.2 previously, so it shows that employment costs are coming down a little bit. Q4 wages and salaries came in at 1.0 versus a 1.3 forecast. So that is something that could help stave off inflation a little bit. MBS initially lost almost a quarter point at the same time, and Treasuries lost ground. Markets have been dismissing Fed members talking about raising policy rate above 5% and holding it there through all of 2023. The big question for this week is, will that change? Expectations are already in place that the Fed will be hawkish, and that Fed Chair Jerome Powell's press conference will reiterate the message that the Fed will stand strong on its quest for 2% inflation. Home prices fell 0.1% month over month and rose 8.2% year over year, which is actually a pretty strong number. According to the FHFA House Price Index, the West Coast is experiencing the biggest slowdown, followed by the mountain states. Some of these MSAs, like Boise, became completely disconnected from the local economy, and prices will almost certainly contract to what the local economy can support. Home prices fell 0.5% month over month, according to Case Shiller. The FHFA number only indicates on loans that are within the conforming limits, whereas Case-Shiller includes jumbo. November 2022 marked the 5th consecutive month of declining home prices in the U.S. The national composite fell 0.6% for the month, reflecting a negative 3.6% decline since the market peaked in June of 2022. We saw comparable patterns in the 10 and 20 city composites, both of which stand more than 5% below their June peaks. These declines, of course, come in a very strong price increases in 2021 and the first half of 2022. Despite this recent weakness, the year-over-year basis for the composite is up 7.7%, which in the 74th percentile of historical performance levels. Consumer confidence fell in January. According to the Conference Board, consumers were less upbeat on the short-term outlook for jobs. They also expect business conditions to worsen in the near term. Despite that, consumers expect their incomes to remain relatively stable in the months ahead. Meanwhile, purchasing plans for auto and appliances held steady, but fewer consumers are planning on buying a home. Dummies. Consumers' expectation for inflation ticked up slightly from 6.6% to 6.8% over the next 12 months, but inflation expectations are still down from its peak of 7.9% last seen in June. I don't think people realize those are really big numbers. The U.S. economy grew 2.9% in the fourth quarter of 2022, down slightly from 3.2% in the third quarter. In 2022, GDP grew 1%, a pleasant surprise given the negative growth in 2022 quarter one. However, stripping out inventory changes, net trade, and government spending to get at the underlying sustainable growth trend, GDP grew at an anemic 0.2% in the fourth quarter. The labor market remains surprisingly strong, but rate hikes will continue to make themselves increasingly felt in the 2023 progresses. At the end of the day, we ended up being up 13 basis points at 100.5. This bold red line that has been serving as a real strong ceiling is at 101.671, so we're in the upper third of that range. The range is a very narrowing one. It is getting even more narrow because the floor is a convergence of the 25 and 50-day moving averages, and then we even have the 200-day moving average coming down as a new ceiling that can possibly collapse on top of the other one. Redfin put out a piece about how the housing market is beginning to recover. Those in luxury properties are unpopular, but smaller properties that are well maintained in good school districts are moving quickly. Buyers are out there, but they're making low offers and asking for concessions. They don't seem ultra committed to the homes like they used to. If they write an offer and they don't get exactly what they want, they're happy to walk away. Also got some interesting stats here for all of 2022. United Wholesale Mortgage transferred $98.8 billion worth of bulk MSRs, more than any other non-bank. So this shows that with originations slacking, they're making up the money by selling off these MSRs, but that will be a finite amount, and that is a lot of MSRs. Also from our sponsor, we got the first in a series of posts. This is learning to write sales copy. So it's all about copywriting. So if you're going to put things on the internet, like the ad you probably saw for this blog, you better know how to write sales copy and make it compelling. And this series will teach you how at WellThatMakesSense.com. And then Wednesday was the day we've all been waiting for, Fed Day. MBS were up 9 basis points on the open. The 10-year was down 7 basis points. Bonds were almost perfectly flat in Asia, then slightly stronger in Europe. Notably, EU bonds were pulled back into negative territory earlier this morning, while U.S. yields remained a bit lower. ADP data clearly delivered a jolt of volume and a smaller jolt of directional trading. All in all, the move was worth less than 3 basis points to the 10-year, but it was in the right direction. ADP employment showed 106,000 job creations versus 178 forecast and 253 last time. So that's a big difference, and hopefully will help out with inflation. We hate to see people not getting jobs, but we need this for inflation to stifle. Most of the growth came from the hospitality industry, which added roughly 95,000 positions. Then we got the JOLTS, the job openings and labor turnover survey, which came in at 11.01 on a 10.44 previous. So that one actually went back the opposite direction. Pay growth was plus 7.3% for job stayers, plus 15.4% for job changers. Leisure and hospitality saw increases of about 10% and was the outlier compared to the rest of the sectors, which were bunched between the 6.6 and 7.9% gain. This is something that will bother the Fed, as services excluding housing is their target for inflation reduction. The youngest cohort, 16 to 24, saw the biggest wage increase as well. So what we're seeing wage increase, which is going to help people pay those credit cards that they're racking up. But also this is a skewed stat because this is a lot of part-time hospitality young people where they're going from, $8 an hour to $8.50 an hour. We were pretty sure we knew what the Fed was going to do and say, and what Powell was going to say today's press conference. He turned out to be generally predictable. After all, we're really only two things we're looking at the Fed can say right now is we still need to see more progress on inflation, and B, we will determine when the job is done by data. So data is going to determine it. Despite Powell's unsurprising comments, the market was apparently surprised or relieved. This is surprising considering the simple list of routes the Fed had in its playbook. Perhaps it's as simple as the market being overly prepared for a hawkish smackdown from Powell and instead got a logical approach. At the end of the day, where it came in at 101.75, which was up a quarter, which bounces us actually up into that new range. We've been bouncing off the ceiling at 101.671 for, what is that, about a month and a half now. So that busts us into the new range, and it looks like it even made a run at the 200-day moving average at 101.937 before resting in. Have to see if tomorrow the range holds on that. The spread between mortgage rates and the 10-year Treasury has been abnormally wide since 2022, or at least early 2022. Further narrowing of that spread is expected to put downward pressure on mortgage rates in the coming months. This is the good news. So as everybody feels like they know what the Fed is going to do, there's a chance where rates could narrow down and your MBS rates can come down closer to the Treasury rate. So that would be much needed. This is why a lot of people are thinking rates will come down to the 5s sometime fairly soon. We did get some info from MBS spreads yesterday, courtesy of AGNC Investment, a mortgage REIT, which announced its fourth quarter results. Mortgage REITs invest in mortgage-backed securities, and they are often the buyer of Fannie and Freddie securitizations. Think of them as the ultimate lender for your production. For the past year, the mortgage REITs have been reporting declines in book value as MBS spreads have widened. So as these have widened, they've had to state down and make it look like they aren't making as much money or holding as much money. In other words, MBS have fallen in value with interest rates, but the hedges mortgage REITs have used have not increased in value enough to make up for the losses. So this is a big problem for mortgage bankers because the items that they're using to hedge your loans while you are processing them are not matching up with what the actual prices you get at the end are. So that's a big problem. So hopefully with some stability, we can get that stuff worked out. This spread increased significantly in 2022, which exacerbated the increase in mortgage rates from 3.27 to 6.66%. 666, terrifying, oh no. And on Thursday, we got a reminder that the United States is not the only country in the world. UMBS were down 6 basis points real early. 10-year was down 5. Both Bank of England and European Central Bank released policy announcements early this morning. Both were as expected in forms of rate hikes. The ECB took a somewhat different approach and pre-committed the next rate hike, another 50 basis points, but said it would reassess after that. That would be like the Fed saying it knows exactly what the terminal rate is and letting the market know when it's coming. Though they've been giving pretty good hits. The ECB said its reinvestments would continue through the end of 2024 and that its balance sheet runoff would be managed to avoid interference with the appropriate monetary policy stance. That's a very weird and confusing comment since the balance sheet runoff is part of the policy stance. We take it to mean that the ECB wants a smaller balance sheet, but it doesn't want to cause too much policy tightening in the pursuit of the goal. As such, it may slow the pace of roll-offs if inflation and growth contract enough. We also got jobless claims. Came in at 183,000 jobless claims on a 2,000 forecast. It was 186 previously. Jobs are holding strong. Unit labor costs came in at 1.1 versus a 1.5 forecast. So we're keeping a lot of jobs, but they are not really super high-paying jobs a lot of times. Powell's comment Wednesday that the disinflation process has started suggested that the aggressive tightening cycle is starting to reduce the pace of price growth, even as it warned of a couple more hikes to come. Positioning in U.S. swaps market assumes the Fed is getting closer to cutting rates as traders bet that economic conditions are likely to keep it from additional rate increases that policymakers still anticipate. I think they're wrong. I think they're going to keep hiking rates until we are right around 2%, and they don't really give a crap what the stock market thinks. The Fed Fund futures currently see 85% chance of another 25 basis point hike in March and 15% handicapping no change at all. The markets see a 30% chance of another 25 basis point hike in the May meeting. The yield curve continues to invert. The 2 to 10 spread is 71 basis points. Non-farm productivity increased 3% in the fourth quarter of 2022. Non-farm productivity has been bad lately, so increase is good. Output increased 3.5%, while hours worked rose 0.5%. Labor unit costs rose 1.1% as compensation rose 4.5%, and productivity rose 3%. At the end of the day, we ended up exactly flat at 101.75. You can see right there that we actually tested out the 200-day moving average ceiling, and it failed, but it also went down below that 101.671 Fibonacci line that was a really tough ceiling for a long time. So that's a very narrow range, but we got a lot of support on both sides. So hopefully there will be some stability. That's really what the market needs right now. Pulte Homes announced fourth quarter earnings with a 20% increase in revenues and another 200 basis point increase in gross margin. I'm going to read that again because we talk about this all the time. Pulte Homes announced fourth quarter earnings with 20% increase in revenues and 200 basis point increase in gross margin. This increase in gross margin means that Pulte hasn't been forced to grant concessions to move the inventory. I am so over these builder sentiment surveys. Revenue is up 20%, 200 basis point increase, and you're sad because you can't build them fast enough. Yeah, orders are down 41%. They're for all of us. Come on, get over it. Double it. That's a mortgage company. Let's get over it. Plus, the home builder ETF is up 29% over the last 3 months. You can take your sentiment and, hey, the Biden administration is planning on releasing a tenant bill of rights, which has been drafted by community organizers and pro-tenant lawyers. It will attempt to find a way to impose a national rent control. Ultimately, the problem is that the housing is in dire shortage, and these measures will do nothing to increase supply. If anything, expropriation of property rights will cause investors to raise the required rate of return and take into account regulatory risk. See Wells Fargo, which means new investment will get harder, not easier. Then we got another post from our sponsor at WellThatMakesSense.com. This is all about sales copy. If you're writing anything, if you're writing a blog, even if you're talking into a microphone like I'm doing right now, you got to learn about sales copy and how to construct things that sell. So check it out on www.wellthatmakessense.com. MBS were in a bad way right from the start today. Rough start. UMBS were down 30 basis points right away, bright and early this morning, based off of the non-farm payrolls report that came in today and crushed the market. Non-farm payrolls came in as adding 517,000 jobs versus 185,000 forecast. It was a very high print at 260,000 last month, so the 517 is incredibly high. Unemployment came in at 3.4% versus 3.6% forecast, which is 3.5 previously. The numbers on that number just don't ever make any sense to me. How do we add that many jobs and it only changes that much? Earnings came in at 0.3 on a 0.3 forecast. It was 0.4 previously. We also got 71,000 in positive revisions for November and December. We don't have explanations yet or even the ability to comprehend the size of the beat in juxtaposition to this month's labor data that's been released so far. Almost seems like somebody messed up an Excel formula or something. We do know the bonds are selling off heavily all day in response to it. On a deeper dive into the report of the 894,000 job creations, 606,000 were part-time. Average hourly earnings were up 0.3% in January, which is 4.4% year over year. Average weekly earnings, which what really matters, is up 1.3% in January, which is up 4.7% year over year. Boy, just enough money for people to keep putting stuff on credit cards. Remember, ADP earlier this week came in at plus 106,000, so there's a big disconnect here between these two reports. ISM non-manufacturing index came in at 55.2 on a 50.4 forecast. So all of this data is adding up to maybe the Fed wasn't right this week and inflation isn't calming down because the job market seems to be getting better if this is all true. Coming into the week, yields were near the top of a narrow range at 3.4 to 3.56 on the 10-year. With both ISM reports, the jobs report, policy announcements from the Fed, ECB, and BOE, it was a distinct possibility that we'd see the range broken by Thursday morning. That looked like it was a work in progress. Then in a cruel twist of fate, the non-farm payrolls beat forecast by the widest margin. Year and a half, 90 minutes later, ISM crushed all forecasts as well. These events combined to push yields to the top of the range on the 10-year. leaving us to hurry up and wait for the next set of potential market movers, which is going to take some stuff. At the end of the day, we were down 39 basis points on the 5.5, and the 10-year was up 12 basis points, ending up 3.51. On the MBS, that puts us right around at 101.36, puts us back down in this very narrow range between that Fibonacci 38.2 retracement and a couple of converging indicators right around 101.238. So we did test that 200-day moving average, which was a nice line. We hoped it would help, and it did not. Looking at next week, we don't have a ton of stuff coming. We do have a 3-year note auction on Tuesday, nothing on Monday. We have a 10-year note auction on Wednesday, 30-year bond auction on Thursday, and then we do get the federal budget on Friday, which is almost assuredly going to show that there's going to be a whole bunch of debt issued. Over the weekend, if you have some time, check out our common sources and influences, especially www.WellThatMakesSense.com, because if you have to communicate with anybody in a positive manner, in a productive manner, you'll want to know about copywriting, and that's what we're talking about right now on WellThatMakesSense.com.